Okay, this is timing strategies for Tuesday, June 17th. We're having some difficulty with YouTube posting the actual videos that we're putting into them, and I'm not a tech, so if it doesn't work, I don't know what to do next, and I'm not going to try to chase it down because I don't know, but we'll cross that bridge. We'll see what this one does when we try to submit it. Okay, so when we left off, if you look at our previous postings, we were looking to get long at some of these levels. We had a 35% long green up arrow posted. We took that question mark off. We got long on Thursday, June the 12th. Instead of 35%, we got long 30%. On Friday the 13th, we took that position off and went completely to cash, 100%. Worked out pretty good because if you look at the Qs on the NASDAQ, we got a real nice little pop out of the Qs from that position, probably the biggest piece. And again, we took that off on Monday. But on the spiders or the S&P, we didn't get a whole lot. Monday, yesterday, we actually went short 25%, and that's what that yellow arrow indicates. We went short 25% in our basket using our Ridex end of day system. And we'll hold that short position until one of two things happen. We either get a move down to this 1310, 1320 level on the S&P cash, which comes out to about 131.75, 131.75, 132 on the spiders. If we get down to that level and price action demonstrates what we've been looking for a while, we may get long 35 to 50%. I'm starting to lose faith in the market as far as any kind of real elasticity for a bounce, so that is a big maybe, and that's why that question mark is there at all times. But again, presently we are 25% short from Monday. Real quick, I want to present one of the quandaries that I'm sure everybody has figured out by now, but just to touch on it. You look at the previous chart, that was the S&P, this is the NASDAQ 100. Big divergence here. I think one of the two things is going to happen. Either the S&P is going to drag down the NASDAQ and the small cap indices. There's the IWM. Either the S&P, the big indexes, are going to drag down the NASDAQ and the small caps and the Russell. Or if the S&P and the NASDAQ bottom, which what we're looking for here pretty quick, because if you look at the diamonds, we've got a price target on the diamonds to actually get long right in here between 120 and 120.50 to 118, 119. Now it's a big window, but again, price action will dictate actually what we do. We're actually looking to get long using the diamonds as the Dow as part of our system because it's a consensus model around this area. And what's going to happen is, are the Dow and the S&P going to push the rest of the market up, the NASDAQ and the small cap up, or are those indices going to drag the Dow and the S&P actually lower? I'm of the opinion that we're going to see some kind of a spread action where the Russell and the Dow are actually going to move lower, and the Dow and the S&P are actually going to move higher. If that's the case, I don't know. But we're prepared to do a spread, maybe go long the Dow, S&P, and short partial NASDAQ and Russell in a volatility adjusted basket. We don't know, but something should happen here in the next day or two because we've got end of quarter coming up in another 2 weeks. Options and futures expiration rollover in another 2-3 days this Friday. So something's happening, and oil at $1.40, $1.30 back and forth. We'll see. Bring up the banking index, the BKX, $BKX. I'm looking to get long some financials based on the BKX. If we can get the BKX down to 62 to 61 in the next day or two and see some sort of volatility on a price expansion in volume and bar range, it's got to be more or less a one-day event. It can't just drip, drip, drift, dribble, dribble, dribble. That doesn't interest me as far as making any kind of a long position. Best indicator I'm looking for that on an individual stock is Bank of America. Bank of America can do a big dump and bring us down to the 26.5 level or a little bit lower, and then show some sort of strength back above. And again, price action is the key indicator or ingredient. That will help give us a little more confirmation for this financials. Will the financials bounce and push the rest of the market up? And in that case, big cap stocks that are in the financials, will they be bought, and will the rest of the market, like the metals, and the oils be sold. I mean, everybody's talking about that in Wall Street and yakety yak. It hasn't happened yet. It's been the biggest Charlie Brown and Lucy with the football ever since they started talking about it. Eventually it may happen. I don't know. We'll have to see a little more volatility on both ends because things are so dry right now. There's no volume, there's no volatility. It's just frustrating. And here's the XLE. I'm looking for the XLE to trade back down somewhere into the median price channel, right around there at the $79, $80 price tag. And we're short the XLE using the Doug. That has had mixed results. We're a little better than break even for client accounts, but not much. And then we get to the XLF. That again is going to key off the banking sector. The XLF, if we can get the XLF to bust this low at the $22 mark, trade down below there with some volume, some price expansion, some volatility, as deep as $20.50 to as deep as $18. That will be a beautiful buy. At that point, yes. I don't know if if we're going to get that or if we even want that. If if it gets that low, do you want to buy it? Maybe for a short-term trade. Again, we don't want drift, dribble. We need volatility. We need an event. We need a bang and a big day with volume, price expansion, things of that nature. Last point I'll bring up here is the emerging markets. Well, the second to last. No, that's not the emerging markets. We're short the emerging markets using the EEV, double short ETF. Looking to potentially buy the EEV somewhere in this level between the 137 to the 129. Again, just based on regression. Below that channel, which is very possible, we might just put that short back on. But again, we've got the EEV for client accounts, which is working out pretty good. But it's always a day-by-day, day-to-day thing. Last point we'll go to is the GLD because everybody loves gold. What's happening here? Your guess is as good as mine. I was anticipating we'd have saw a breakdown at least to that median channel, somewhere to the $82 to $81 price tag sometime by now. Before now, we haven't seen it. So, sometimes your guess or anybody's guess is as good as mine. It's not happening. I strongly believe the Fed is holding this market up, and that's why we're not getting free market price action, which would give the market a washout, and some buyers would come in, and that would actually sustain it. But this, let me give you one last piece of venom here. Hey, Goldman Sachs. Our Treasury Secretary, here's a stock of Goldman Sachs, and they're just a bunch of geniuses, and they're just the smartest guys in the room, and they can make money when none of the other brokers and none of the other banks and everybody else is losing money. They're making it hand over fist. Goldman Sachs. If anybody wants opinions on Goldman Sachs, I'm not going to put them out here for the public. Give me a call, send me an email. I'll give you my 2 cents worth on them, but and there's plenty of it. But don't put too much faith in Goldman Sachs long term. Anyway, so back to the rest of the market commentary. Looking here, 131.75, 132 on the major indice on the S&P. We'll see what happens if we get that. If the market takes off, we don't get that trade down to there, and we take off back above that 137 or 1370 to 1370, 137.50, back above that price range, we may reverse our short position and get long temporarily. Okay, that's it for now. Let's see if this posts.